So Chaturanga, this is a good way to visualize this as well.
Hmm.
Now say we have our opening inventory plus cost of goods purchased or produced. So opening inventory plus what you have produced or purchased is the total goods available for sale. From that to deduct the closing inventory, that is your cost of goods sold. Is that right? Opening inventory plus purchases minus the closing inventory is our cost of sales. So from sales, you deduct the cost of sales and you get the gross profit. From that, you deduct the expenses, then you get your net profit. Okay?
Hmm.
And then this is your income statement. And then in your balance sheet, you have current assets. And then equity, you have retained profit plus the net profit. That will become the total retained profit. Your beginning retained profit plus the profit for the period will be your ending retained profit. So this is the balance sheet. Now, Haridhan, is that okay?
Yeah.
Now, due to some reason, if this is overstated, right? Overstated is you're indicating a higher value than it should be for your closing inventory. So this is overstated means, so that means the cost of sales should have actually been lower, higher, but since you are deducting this amount, you are understating the cost of sales. Because inventory value you take out is higher, so you are overstating the inventory, so therefore you are understating the cost. Means when you understate the cost, you are overstating the profit, gross profit, as well as you will be overstating the net profit. So when you overstating the net profit, all the profits will be overstating since the cost is understated due to the inventory. So if the net profit is overstated, so that means the retained earnings also will be overstated. So the balance sheet, the retained earning will be overstated. On the other hand, current assets also will be overstated. So the profit and the current assets both will be overstated. Okay?
Yeah.
On the other hand, at the end of the year, retained earnings is correctly stated as at the end of the second year, what is going to happen is now this is overstated. But now during this period, also then you do the correction when it is corrected. One moment. Corrected. Oh gosh. Right? So then this is overstated. The beginning inventory is overstated. So that means whatever when you get the purchases, goods available for sale also will be overstated because now the inventory is overstated. And then when this total thing is overstated, our cost of goods sold is overstated because we are taking a higher value than what it should be. So your cost, this is overstated, your cost of goods sold is overstated. When the cost of sales is overstated, gross profit is understated. Net income also understated. So that means here also it will be understated. So therefore it is already overstated, but it is getting corrected here. So now what the overstated amount in the previous period, now it is corrected because here it is going to be understated because you start with a overstated inventory value. So therefore it's not going to continue that mistake. Once the next period, the whole thing will be corrected. So that is what they say. Just get the broad picture, but again, we may have to look at the question to understand it further. But this overstating, just you have to you just look at a draw a diagram like this on your own, and then see, just start thinking through if this happens to the inventory, what will be the impact? If this happens to the opening inventory, what will happen to the goods available for sale? What will happen to the cost of sales? What will happen to the gross profit, net profit? What will happen to the retained profit? and the inventory. If the other way around, what will happen? Just you have to be very clear with regard to this logic. Okay.
Yep.
Right.
Clear.
Done. Now, what I'm thinking is, see, this is out of these 29 pages, we took almost one lecture, right? We haven't even completed half of that, right? It takes a lot of time. This is very broad. So many things are there in this
Yeah,
curriculum.
that's the thing. So many things are there that we have to understand and more.
Yeah, because it has financial accounting, management accounting, financial management, analysis, everything is there.
We have to
Right.
read. I
Huh?
mean, to read also it takes some time because there are certain things that I understand.
Yeah. The reading and then also piloting these standards and these certain things you won't remember also no, when you initially when you
Yeah.
read. So you have
Mm.
to, that is also another thing. So you have to read a couple of times questions, then only you should be able to make use of that knowledge. Let's see whether we can continue for another very short while, at least part of this can be completed. Okay.
Yep.
Right. So now we are going to look at property, plant and equipment. That is the next segment. You remember this is where we started. Current assets, including cash, account receivable, and the inventory. This is what you have completed. Long-term assets, including property, plant and equipment, and depreciation. That is what we're trying to look at now. So property, plant and equipment, also called the fixed assets, consists of tangible property expected to be used in for more than 1 year that is held for the production or supply of goods and services. So that is a tangible property used for more than 1 year. You're going to use it for more than 1 year and you're going to produce goods or supply services. Or else you're going to use them to produce goods or provide services or rent to the others also you may have this. Or you may use them for administrative purposes as well. Right? You are going to use them for produce goods or offer services or rent to outsiders, or you're going to use it for other administrative purposes. Right? And again, PPE also will be at the carrying value. Now, this is a little bit of simple, straightforward theory. So, initial value of the plant and equipment will be our purchase price, obviously. Your purchase price minus the trade discounts and rebates. Your trade discounts, rebates, plus purchase taxes and import duties. All of them will be there. Net purchases. Price minus the discounts and rebates, plus any purchase taxes, duties, all of them will be there. That is the price. In addition to that, whatever that is directly attributable cost of bringing the asset to the location and condition needed for its standard operation. So you have to bring it, you buy it, any discount, minus any discounts, any taxes, you and everything. And you need to bring it to your own premises. What is the cost that you incur into the coming premises? And you have to make it into a usable form. So you may be making certain changes, installations, and things like that, right? Such as architects and engineers fees, site preparation, delivery and handling, installation, assembly, and testing. All of that are included there. The initial investment cost that the entity is obliged to incur at the end of the asset's useful life to dismantle and remove the item and restore the site in which it is located. So this is not a very commonly spoken about thing. So after at the end of the period, let us say you have to remove, dismantle, and you have to prepare the location ready for another rest of the activities. So therefore, that dismantling cost also you can actually, what is going to be incurred at the end of the period, you can add it to the cost of the asset, and that also can be absorbed over a period to your depreciation. This may not be very significant for certain types of assets, but if there are toxic assets, the nuclear material in a nuclear power plant and things like that. So then this cost can be very, very radioactive elements and all those things, or nuclear or radioactive. So then those things can be insignificant. So obviously purchase price plus all the costs that you're incurring in getting into the status and the place. And then of course, the cost of restoring the assets or cleaning, dismantling, removing and getting it ready the way it was. That is another one. And on top of that, borrowing costs attributable to the acquisition, construction, production of an asset that takes a long time to prepare for the intended use. If you have any borrowing costs also incur, so that also will be included there. That is basically the initial measurement. What will be the value of the property, plant and equipment? Is that clear?
Yes.
Yeah. And then subsequent expenditure. Capital expenditures provide additional benefits by improving the quality of the services rendered by the asset, extending the useful life or increase its output. Sometimes after you incur the capital expenditure, it may provide additional benefits by improving the quality of the service. Quality of the product or the service will improve by the asset, or it may extend the useful life, or it may increase the output. Efficiencies may be improved. These expenditures are capitalized, included in the asset's cost. Capital expenditure capitalized as the asset on the entity's balance sheet. So sometimes you make these asset improvements and things like that, which will increase the useful life, it will increase the output, which will increase the efficiencies. Those things also you will be capitalizing. The subsequent expenditure also will be capitalized as a part of the asset. Revenue expenditures such as routine repair and maintenance cost maintain an asset's normal service capacity. So on the other hand, revenue expenditure are the things that it will not enhance the value, it will not extend the useful life, it will not increase the capacity, it will not reduce the wastages. So those things, day-to-day servicing things, you are not going to capitalize it. That will be a part of your operational expenses. But if it is going to improve the efficiencies, reduce the wastages, extend the useful life, so then it has to be added to the subsequent expenditure will be added to the property, plant and equipment value. If not, it is just a revenue expenditure. And the distinction between the capital expenditure and revenue expenditure is important for internal auditors, because managers may incline to capitalize the capital expenditure to avoid their expenses. So managers will have the tendency, the revenue expenditure also capitalized, so that will be depreciated over a period of time, so that the profit is increased. So you got to be careful what method, what they do with these operational expenses. They should not capitalize at any point. Is that clear? Shall I move on?
Yeah, yeah.
Right. Right. So initial recognition will be property, plant and equipment is reported in the financial statement as the carrying amount, which is the historical cost. Whatever the cost that you have incurred minus the accumulated depreciation, right? And then apart from that, any impairment losses. If you feel that the value is not right, IFRS provides the revaluation model as an amendment to the cost model. Accumulated depreciation is contrast asset amount that reduces the value of the PPE. So you have your asset, historical cost, and then the depreciation, accumulated depreciation reduces the value of the asset, obviously. That is why it's a contra assets, right? And then if there are any impairment loss, you have to reduce that, and then only you calculate the whatever the carrying amount. Cost plus minus the depreciation, obviously, and then impairment losses you minus. So that is the value of the asset that you show in the balance sheet. So PP must be reviewed annually for impairment. Impairment refers to the reduction on assets value. Entries must test for impairment to determine whether the carrying amount of these assets is not recoverable. So if you just because you have a carrying value of the asset, historical cost minus depreciation, If that there is a carrying value, but then if that is not recoverable, that is why you need to adjust the impairment losses. That's why you need to adjust the impairment losses. The independent perspective of the internal auditor can support the credibility of the impairment testing process. So that's a difference to how the internal auditor could contribute in that exercise, right? Now we look at the depreciation. Depreciation is the process of systematically and rationally allocating the tangible assets depreciable base over its expected useful life. So depreciable base is your initial cost plus the installation, all those values added together. How that is going to be absorbed over the useful life is what you mean by depreciation. Periodic depreciation expense is recognized in the income statement. Obviously, when there's depreciation, it is charged to the income statement. Take it out from asset and put it in the income statement. Accumulated depreciation is a contra asset account. Accumulated depreciation is basically we have depreciation, right? You keep on depreciating the depreciation provision account. So it is always you have an asset. The first year depreciation will be there in the depreciation provision account. You show that as a contra asset. You will not only show the depreciation asset value, but asset value minus the depreciation you indicate as the net value as the value of the asset. In the periodic depreciation adjustment entry, the debit is to depreciable expenses and the credit is to accumulated the depreciation. So that's how you do it. Depreciate now when you depreciate an asset. So when you buy an asset, say for 100,000, let us say you buy an asset for 100,000. You have 100,000, and when you depreciate it, you create depreciation account 10,000, for example. That's an expense. And you create the provision depreciation account credit. So what you depreciate amount will go to the income statement, but the provision and depreciation of say 10,000, that minus 100,000, that the net value only will be considered as the asset value. So that's a normal transaction. The assets depreciable base is basically what is the value that you're going to depreciate is the historical cost. We discuss what are the things to be included. From that, you minus the estimated salvage value or the residual value. So that is the depreciable base. From the historical cost, you minus the estimated salvage value. So that is the depreciable base. You will be depreciating only that value. Historical cost minus the final salvage value. Estimated useful life is a period of which the entity expects to receive service or economic benefit from the asset. So obviously, useful life is for what period the asset is going to give you benefits. Salvage value is the amount that the entity expects to obtain from the disposal of the asset at the end of the asset's useful life. So salvage value is at the end of the useful value, how much value you are going to realize it. That is the salvage value. Simple thing. Land has an indefinite useful life and therefore must not be depreciated, obviously. Thus, the depreciable base of property consists of land and building is the depreciable base of the property that consists of land and building. Even if you have land and building, you need to separate the depreciable component, building. That is only what you are going to depreciate over the useful life after deducting the salvage value. Say, at the beginning of the year, the manufacturer paid 270,000 for the new machine. Estimate that the end of the machine's 5-year period, it will have a value of sell the machine at 20. So depreciable base will be 270 minus 20. 250 is a depreciable base. Simple thing. Right? So when we use straight line depreciation, 250,000 is the value. There is no salvage value. So depreciable base is 250,000. Estimated useful life is 250 divided by 5. That is 50,000. So 255, 50,000 is depreciation expense, and accumulated depreciation also in the first year it is 50. Right? So that means the book value 250 minus 50 will be the value there. And then the second year also you will depreciation 50. Altogether depreciable asset will be accumulated depreciation will be 100. So like that, this is the basic depreciation entry that you will be having. So that is the normal one. Now here what it says, unit of production method is basically what you do is, when we want to start depreciating an asset, what we first do is we will estimate what is the number of units that can be produced with that asset. We need to have a fairly reasonable estimate whether we are going to produce, how many units you can produce with that asset. Based on the manufacturer specifications and everything, you decide certain number of units. So therefore, unit depreciation is very simple. What is the value you are going to depreciate, and what is the total number of units that the asset is going to produce during the lifetime? Right? The number of units that the asset is going to prepare during the lifetime is the total lifetime units. So your cost that you're going to depreciate, the cost minus the uh, uh, recoverable value, salvage value, you divide by the estimated useful total lifetime unit, you get the depreciation per unit. And each and every period, say, depending on the number of units that you're going to produce, you will be depreciating based on that. Say you have 1 million worth of asset, which is going to generate 500,000 units during the lifetime. So 1 million divided by 500,000 is $2 per unit. So in a particular year, you produce 100 units, it will be 2 into 100. Another year, you will produce 1,000 units, 2 into 1,000, 2,000. Like that, you depreciate based on that. And the third method, we call the accelerated method. We have assumed weightages, assuming that if you depreciate faster or slower, we put weightages, and based on those weightages also we can do the depreciation. That is basically some of the digits message where we don't have a calculational example here. Okay, so that's, I think, good enough for today. So we've gone through this cash, receivables, and inventory and fixed assets, tangible fixed assets. We discussed those area. So now we need to, next week, probably we need to get into the rest of the discussion in terms of other assets and all those things. Okay.
Right. Yes.
Yeah, Chaturanga, I think it took a little bit of a time. Are we okay? So shall we wind up? Bit tired as well. What
Yes.
about you?
Same.
You
And
at home
tomorrow is
or you are still in the office?
sorry?
You are in the office or you came home?
No, I was in the office today. Tomorrow is the bar, the big committee. So, things are
Right.
happening.
Right. Okay. Okay, then,
Okay.
Chaturanga.
Okay,
So
then. Good night.
we'll call it a day then with that. Thank you. Good night.
Good night.
Good
Thank
night.
you.